Hi, good evening, everybody. Welcome to Endowus Live, a live webinar brought to you by your friends at Endowus. I'm Sam Ree, the Chairman and Chief Investment Officer at Endowus. Really excited to have Wei Mei Tan, who is our Senior Advisor and Head of Advisory Solutions at Endowus. We're going to be reviewing Endowus's first quarter 2021 portfolio performance and returns. We'll also provide some, market commentary and thoughts about where markets are. It's also a great opportunity for you to ask questions. So we're happy to take a lot of questions today to address any concerns or questions or, areas that you want to explore. As you know, we have a Slido poll. So the Slido poll 720809, just plug it into that. You can upvote the questions that you feel are the best questions, and just leave questions there. I will also check the YouTube chat just in case. But if we can use the Slido Q&A session, that'd be really wonderful. Also, next week we have another. In 2 weeks' time, we have another live webinar, and I don't think that's the original Dogecoin. It's a ripoff of a ripoff crypto. But combating investing FOMO. And for those of you who don't know what FOMO is, it's the fear of missing out and market anxiety. We did a session on GameStop and, investing herd mentality before, which was really fun. So we have two of our best, Sheng Shi, who is our personal finance lead, and also one of our, up and rising stars, Madeline Wee is our client experience person from Endowus. But she has a wealth of experience from the Ministry of Education. She's wonderful, writes wonderfully, and is an exceptional talent for us. So they'll be talking about, things that most excite and interest people. It'll be very personable and fun. So please join us in 2 weeks' time. We'll be sending out an Eventbrite. Look out for that. And obviously we'll be on YouTube and Facebook. So you can always go to our YouTube channel, hit subscribe down below. If you have any questions and you want to talk to Maddie or any of our client experience members, book a consulting appointment also below. And one of our MAS licensed representatives will be happy to, consult your personal investing and any concerns or questions you have with relations to Endowus. Very brief disclaimer for you to see, and then we will jump right into it. So Wei Mei, first of all, maybe you can just say hi before we get going and introduce yourself. Take this opportunity.
Thanks, Sam. Hi, everyone. My name is Wei Mei, and I've recently joined Endowus as the Senior Advisor and also the Head of Advisory Solutions. I've been in the financial industry for the last 20 years. And I've worked across different roles in asset management, investment banking, and also private banking. I started off my career at Temasek as a fixed income portfolio manager. So I've been on the buy side and working on constructing investment portfolios. Subsequent to that, I moved to Hong Kong, where I was working with institutional clients across non-Japan Asia, covering both credit structuring as well as syndication. And in the last 12 years, I have been at various different private banks, starting with UBS, subsequently with Credit Suisse, and most recently with Deutsche Bank, where I was the global co-head of advisory and investment solutions. So throughout my time with private banking clients, I have worked on helping them with their asset allocation, as well as making sure that they were able to focus on investing according to their objectives. I've also got a passion when it comes to digital advisory, having set up various different digital advisory platforms for the private banks. And that's why I'm here at Endowus right now, helping our clients to ensure that they can invest their wealth, leveraging on technology, and also making sure that we can deliver the returns as expected. So I'm looking forward to working very closely with you guys in the coming months. And I hope that you can give me your support right from the start. And I'm certainly looking forward to coming out with more new investment solutions that would be suitable for our Singaporean client base. Over to you, Sam.
Wonderful. Thank you, Wei Mei. And we are so excited to have Wei Mei join the team. As you can, see, Wei Mei has an amazing experience in various businesses, both in investing and asset management, in private banks, finding and making solutions that matter to our clients. And so, I think she brings something that is much needed. And the Endowus is really honored to have her, and really excited that the investment office at Endowus is beefing up with exceptional industry talent, working together with Yulin and Kyungju and Sean and other members of the team to bring exceptional investment solutions, great advice, aligned and in the best interest of the client, and independent, but also access to great funds and products that were not previously available to retail investors and individual investors, but also for Endowus private wealth clients and clients with bespoke needs. We also have an Endowus Gives Back program where we work with charities and nonprofits and societies and endowments and schools, for example, to help their financial needs so that they can remain sustainable and be good stewards of their resources as well. So Wei Mei will be touching various roles across this broad spectrum of work, and also working with our product team on the digitalization of our solutions as well. So wonderful to have Wei Mei join the team. So we're going to jump right into the Q1 review, and this chart tells us the whole story. The global equities continued on its march upwards. So the dark blue and the slightly bluer lines are the MSCI All Country World Index, and the MSCI World Index, which is a slightly lighter blue color, is actually really tracking the ACWI index. And that's because the biggest component of both is the United States and developed markets. And the light blue line, the lightest of the three, is the emerging market. So MSCI emerging markets had a very strong rebound and rallied very hard at the beginning of this year, led by multiple countries in the region. But obviously, we've been hit by some concerns of slowdown. China was first to recover from the COVID situation, but there's concerns about growth there and the Huarong kind of bond and credit issues. India, obviously, we've seen a huge spike in COVID cases, so it's put a bit of a dampener in Asia and emerging markets in general. And as a result, the emerging markets have pulled back a little bit. But another salient point is that fixed income markets, and we'll go into more detail later, has also had a bit of a pullback. And as most people know, as you've been an audience of and seen many of our webinars, fixed income prices, bond prices fall as interest rates rise. And that has caused fixed income markets to correct a little bit. Oftentimes, these are not realized losses, they're mark-to-market losses, which are not fully realized. And many of the fund managers and portfolios that we manage will not be realized losses, but really as long-term investors, we should remain invested. But I think it's really important to analyze what are the driving factors behind these moves and to understand it better. So I'm going to hand over to Wei Mei to go through the next few slides on the macro and the underlying asset classes that have seen performances vary and diverge a little bit during the first quarter.
All right, thanks, Sam. I think first of all, if we look at how the markets have performed, one of the key indicators that would be useful to track to understand where we are in terms of the broader recovery would be to look at earnings. And we're talking about earnings per share here. And if you look at the chart, what it is telling you is that the trailing earnings per share growth continues to be in negative territory. So if you look at where we are right now, which is on the extreme right-hand side, it is still below the zero line. So it means that, yes, we have seen the turn happening, and you can see that has dramatically improved over the last quarter. And it is picking up very quickly. And as we start looking at forward earnings per share, what we are observing is that expectations are improving very significantly to the extent that emerging markets is expected to outperform the other regions. So overall, I think this is a good picture for us. We should be expecting that earnings per share will continue to increase from here. And this is going to drive a broader recovery overall. And across all regions, we should be expecting double digits growth. So I think this is something positive and has also been driving investor sentiment. On to the next page, you'll be able to see which are the equity sectors that have done well. Over the course of the last year, there has been a lot of focus on technology stocks as well as healthcare, predominantly because of the COVID-19 situation. In essence, healthcare was one of the favorite darlings of the stock market because we're expecting them to benefit as a result of the epidemic. Likewise, there was a move towards technology because sectors that was using digitization and offering, let's say, online e-commerce, etc., were doing well during the pandemic itself. However, you do see that in Q1 2021, there has been a rotation. Your favorite sectors like healthcare and technology has lagged behind. And in fact, they are considered the bottom sectors that have underperformed for the first quarter. Whereas more cyclical sectors like energy as well as financial services and also basic materials outperform. So these are the top three sectors that we have seen. And these were in fact the sectors that were lagging back last year. So just over the course of 1 year and roughly about a quarter, you can see that there has been a huge amount of difference. But I think it's important to also see that sometimes when you try to think about technology as the best place to be in, then you realize that the returns are not necessarily in line with what you're expecting. This is also why we have been advocating that it's much better to have a mix of different sectors and obviously more diversification. Moving on, let's now look at something slightly different. And I think this is a very colorful chart. But having said that, the most important point is highlighted for you in the red box, which would be the sectors that have been outperforming in Q1. So in Q1 itself, what you would have noticed at the top would be value stocks as well as small cap. So earlier we talked about sectors, now we're talking about more of the different factor tiers that can showcase a certain level of outperformance. This chart over the course of the last 12 years tells you that it's almost impossible for any single factor or event asset class to continue outperform continuously. It's impossible to try and second guess which is the one that will come up tops in the next quarter or even the next year. And in fact, if you notice the pattern, which is right at the top line, you only see growth stocks being at the top for 2 years, and that was 2019 and 2020. And never before that would you have any single particular sectors here that would show up as continuously outperforming. So that was more or less, in my view, a more outlier situation. But this time around, you see that value stocks have become the champion. Previously, it was always growth orientated. At the same time, small caps have overtaken large cap, and the margin is quite significant. So let's just take a quick look. Just looking at value versus growth is a difference of 9.8% versus 0.3%. Growth is pretty much at the bottom of the ranking. So if you think that you can effectively pick what is best, I think you should reconsider again. It's never quite easy. And the dispersion is so wide that sometimes I think you might end up choosing some of the losers rather than hoping that you come out choosing the winners. So moving on, let's just look at the other area. which is about the returns across different equity markets. I've had quite a bit of feedback that right now, if we just track vaccination rates across different countries, you might be able to pick the next winner when it comes to deciding which stock market is going to emerge as the best. But what I'm trying to share with you here is that vaccination rates have got almost no correlation to stock market returns. In fact, the markets that have outperformed right now, as you see in the red box that I've highlighted for you, Japan and Europe have been the top performers. And we know that in these countries, vaccination rates have been much slower compared to the US as well as the UK. So as a proxy, Europe, as of the end of the first quarter, had a vaccination rate of about 11%, whereas Japan had a 1% vaccination rate as part of their overall population. But yet you do see topics outperforming, being right at the top, whereas US and UK, which is much further ahead when it comes to vaccination rates of their population, have in fact trailed behind. But nonetheless, another explanation for this is in terms of broader sentiment, and that can be tracked by manufacturing as well as service sectors surveys. So those surveys have shown that US is catching up very quickly. US as well as UK are the markets where both manufacturing as well as service sectors have started to do better. But I think a lot of it is because there is pent-up demand and also consumer confidence have started to improve. So those are the different type of indicators that I think it's useful for us to get a broader picture of how the market has been doing. And likewise, if we moved on to looking at what would be the kind of different returns that can be narrowed down between value growth as well as large cap and small cap, this is a very useful table. So just now I've talked about just purely Q1. Now you can see it on a 1 year as well as a 3-year basis. So while in Q1, we all know that value as well as small cap have done better, on a 3-year basis, it's still going to be growth as well as large cap that have done better. So what I'm trying to suggest to you is that what matters more would be over the longer term. Just because Q1 has been a bit more contrarian and not quite what you're expecting, it is just one quarter by itself. Let's look at the longer term trend, and the longer term trend continues to favor both growth as well as large cap. But having said that, because of the dispersion of returns, I would also suggest that you consider a blended portfolio, which is in the middle right there. Because once you have a blended portfolio, which will have a multitude of different factors that are utilized in the portfolio construction, you're going to be better off, right? You're not going to have huge dispersion in terms of returns across time frames. So I think this is a key takeaway, and I'll urge you to consider the need to have a different kind of factors that would be embedded within the investment portfolio that you're constructing.
Okay, thank you, Wei. And I guess the other takeaway is that, these are relatively short periods, even the 1 year and 3 year. So if you look at the really long-term, 10-year plus trends or multi-decade trends, then you do see proven factors of return being consistently value-adding. But we've just gone through a decade where it's actually underperformed. So it goes to show once again that human beings are actually very terrible at predicting the future. Because, at the peak of value outperformance, everybody was saying value is the way. Now at the peak of growth outperformance, we've been shocked that, Q1 2021, we saw value come roaring back. So I think that having a broadly diversified global exposure across geographies, across sector, across, in fixed income, various, credit and duration is also really important. And that's why I'm going to move on to fixed income. So this is a chart of, the recent trend in long end of the interest rate curve, rising quite significantly. The yellow line is where we were a year ago. Orange is just 3 months ago. So it didn't move for a very long time. And, post the COVID crisis, obviously the yield curve flattened because of disinflationary pressures and expectations that inflation will remain very benign, but also because central banks suppressed not only the short end, but also the long end of the curve by purchasing securities, whether it's government or municipal bonds or even investment grade credit at times. So I think that the yield curve steepening is a reflection of the economic recovery that we spoke about. And in the equities market, that's shown up in the earnings curve, but also in the fixed income market, the long end of the curve normally steepens because of inflationary expectations. Now, there are two camps, people who think that inflation will come roaring back, it will be a huge burden on markets and therefore markets will fall. It's really negative for fixed income and rates will rise beyond 3% and into higher territory. And we need that because inflation is going to be very high. But I think the most consensus view is that it's very difficult to see inflation coming back well above any kind of 2-3% range that we saw post the global financial crisis in the US or in most developed markets. And the long-term disinflationary pressures of aging population, lack of growth, and a lot of digital transformation leading to lower prices across service sectors and also income and manufactured products means that the long-term inflationary pressures are still not quite there. And we're only early in the stages of economic recovery, and we're unsure about how vaccination progresses and how the economic normalization will play out. And as a result, we think that yield curves have largely moved quite a lot already, and as a result may not have tremendous upside. And that's why I think the market recently pulled back, and the interest rates also pulled back a little bit from the recent peak. And this is a problem for investors that especially in the safer sovereign space. Increasing amount of countries, number of countries, and increasing portion of the government bond investable universe is now yielding really, really low numbers. And while the US has seen a pickup, we've seen very little pickup in Europe or Japan or other markets, other developed markets. And emerging markets, in many markets, we're still seeing long rates actually being suppressed or falling. People have talked about the risk of investing in fixed income as a result of that, and fixed income has underperformed, as we showed in the performance chart. But if you look at the reason why we diversify the portfolio with exposure to fixed income is really for these kind of times of crisis, because long term these corrections and cyclical periods of cyclical downturns is when fixed income really shines. And so this is an example of the three major fixed income markets globally and how they performed during the four major financial crises and economic downturns that we saw in the recent decades, starting from the tech bubble, which is something that people equate to now. A lot of people are saying that we're in bubble territory. The technology bubble is similar. And so technology, during the technology bubble burst in 1999-2000, the market fell quite, almost 50% in the US. And during that time, fixed income actually performed really well in local currency terms because of the falling interest rates. And similarly, in every single case, and COVID was no different. So initially, fixed income markets, took a hit largely because of a liquidity shortage. So people didn't have enough US dollars, and global, central banks and global corporations and holders of US Treasury actually sold, and actually it led to a small spike in interest rates and prices falling. But as the Fed responded with quantitative easing, and the markets came back very rapidly and actually performed exceptionally well compared to equities and protected our exposure. And so it's really important to understand why we diversify with fixed income. And we talk about the 60-40 portfolio, the balanced portfolio being dead, or it's not as relevant. But fixed income is the portion that everybody's worried about. I think we may, and we'll touch on the 60/40 portfolio and why it's still relevant. But within the fixed income space, it's really important to understand that there's still opportunities. We also use the global, aggregate bond index, which is a government bond index. Also, the JP Morgan Emerging Market Index is also a government sovereign bond index. So everybody has their eyes on that space, and the recent U.S. Treasury yield increasing, and the long end is also U.S. Treasuries, which are sovereigns. But you can see that in many spaces of fixed income, especially in investment grade credit, also high yield, interest rates still and yields are still coming down, and markets have actually done reasonably, held up reasonably better. So there's still opportunities that exist in the fixed income space. And I think also we've touched upon this before. Most people look at fixed income as an income or a yielding asset class, but it is an asset class that generates significant returns from capital appreciation as well. And as interest rates maybe come down again in the future, especially in emerging markets, then I think there's still opportunities for us to have capital appreciation fixed income as well. So it's something to keep in mind. And if we look at the first quarter performances, as we explained, you can see that actually short dated maturity, high yield, for example, gave us actually positive returns. And certain aspects of credit, even high quality credit in the short duration did really well to protect our assets. So I think it's really important to understand the total exposure that we have in fixed income and how they interact and how diverse the fixed income market is. And this is, just an example of how high yield has outperformed in the first quarter. So these charts are, again, very consistent. I noticed that Wei Mei highlighted growth outperforming for 2 consecutive years, and that was the only one. I think earlier we saw, another slide on geography, and I think that, US outperformed for 2 years in 18 and 19 as the best performer. It was the only case where we had 2 consecutive years of outperformance. And the only one that we see, being the best performer is 2014 and 15, where Euro government bonds actually outperformed for 2 consecutive years. So it's interesting that there are a few cases where we've had 2 consecutive years, but you can see how Euro government did in 2016. It was one of the worst performers. And, once again, it's very difficult to predict, which sector or which geography will outperform consistently. This is a portfolio review webinar. So it would be amiss to not address the actual performance of our portfolios. So I'm going to run through this very quickly. These are all publicly available on our landing page website. So if you go to endowus.com and look at how we invest section, and some people miss this, but right at the bottom is all the portfolios that we have, which is the cash and SRS advised portfolios for core. We have, CPF portfolios for core and ESG. Portfolios, and also all the cash smart portfolios. So all our advised portfolios are transparently shown on our website. Even if you're not a client and you haven't signed up with Endowus, you can see everything transparently. And this is, just a summary and putting it in a nice table so that you can look at what our year-to-date first quarter performance was at the end of March, but also last year in 2019-18, so 3 annual returns, and then a 10-year cumulative and annualized return performance for our core advised portfolios. Cash and SRS, remember, is the same portfolio for us. It's globally diversified in nature. It's passive and strategic in asset allocation, and it's really, really low cost, made up of Dimensional and Vanguard managed Infinity portfolios, as well as PIMCO and Dimensional fixed income portfolios. And as you can see, last year was an exceptional year for us in terms of performance, especially for fixed income, where we did really well. But our cash SRS portfolios, with this exposure to Dimensional and the proven factors of return, although it's broadly passive in terms of the market exposure, it is tilted towards the factors such as small and value and quality. and therefore it slightly underperformed the market last year in terms of equities and the balanced portfolios. But this year, obviously, we've seen that roaring back, and we put in the MSCI All Country World Index factor returns for small and value and small value, if you combine that, and how they performed this year. Small started outperforming last year, and then it's continued its outperformance into this year. Value underperformed slightly after underperforming quite a lot in 2019, but it's come back quite strongly this year. And that has all contributed to the equities portfolio doing slightly better. The fixed income portfolio, which has always done really, really well, has fallen. It's a negative number in absolute terms. Obviously, if you look at the broad global aggregate and EM bond exposure, we're actually not far behind. We're largely around benchmark in terms of returns. But hopefully, as markets rebound, we'll continue to be able to generate good returns for the fixed income portfolio. On the factors, just very quickly on how that the dynamics worked in the first quarter between small and large, and then value versus growth, and then profitability, the three major factors. For that was for developed markets and emerging markets as well. So it's quite prevalent across developed and emerging markets, both all three factors of size, relative value, and profitability did relatively well compared to the large and growth and low profitability factors. Moving on to the CPF portfolio, obviously we are much more limited in the way we can build the CPF portfolios. Dimensional is not in CPF right now, although we hope that to have them included very soon. So as they get included, we will be launching CPF portfolios, including dimensional portfolios. But for now, we have a globally diversified multi-manager, multi-asset portfolio for CPFs. And you can see that the portfolios across equities and fixed income, just like cash and SRS last year, did very well, doing slightly better than benchmark indices. And this year, we are continuing that trend with the equities doing slightly below benchmark, but largely tracking the benchmark quite well. And then the fixed income has actually almost the exact return as the cash SRS portfolio after doing really well last year. And then the final piece is the cash management portfolios. As you know, we've just recently launched Cash Smart Ultra, which I'll touch upon at the end. There's a separate webinar and insights article on it, so please check it out. But Core, Enhanced, and Ultra has all tracked their risk metrics, and last year gave us above expectations and above our conservative forecast net yield. However, the 100% fixed income portfolios, which are the ultra defensive portfolio and the 100% fixed income portfolios, both fell in negative territory in the first quarter. The ultra defensive portfolio being slightly more defensive, as it should, with its exposure to some short duration funds, which have done slightly better than the pure fixed income market exposure. So, we'll touch upon the cash smart portfolios, how short-term volatility has, affected especially the higher risk versions of cash smart, which is enhanced and ultra. Core has not budged, has not had a negative return day, has remained very steady, yielding above 1%, as you can see. And enhanced and ultra has recently seen a bit of a correction, but ultra has had a strong bounce back in recent weeks as well. And then we compare that to the fixed income portfolios, and you can see that the volatility in cash smart is really very, very small compared to fixed income. And if you chart this against the equities portfolio, then the fixed income portfolio will look like a straight line. We actually showed that in our first slide. You can see that the fixed income performance is like flat versus the equities volatility. So the portfolios have been designed for a purpose, and it's done exactly what it was supposed to do. And so this is, a good way to manage your asset allocation across the various advice portfolios that Endowus has. I'll hand over to Wei Mei to talk about the 2Q outlook.
Thanks, Sam. So as we move into the next quarter, I think all the eyes are on the overall progress when it comes to arriving at herd immunity. And I wanted to first touch on the chart on the left. I think we have, as a whole, been making remarkable progress when it comes to vaccine development. I think there are still naysayers out there that this is taking too long for the pandemic to be over. Let's just compare what the situation had been for, let's say, SARS as well as for Ebola, where the vaccine took a much longer time for it to be developed. So you can see in the chart here that in less than a year, at least for COVID-19, we do have a vaccine that's already out there. But I think the key here is how long will it take for the world to achieve herd immunity? And that's measured by the population of at least 75% getting the vaccination done. So if you look at the league table there on the right, we will have countries like Israel that is going to be ahead of everyone else. And of course, US and UK, as you know it, is also at the top. But for the world as a whole to try and achieve 75% of the population getting their vaccine, this is going to take us approximately 7 years based on the consensus that we were reviewing. So I would anticipate that while there is a recovery and it is getting a lot more positive, we should still take heed that it is likely going to be taking much longer, and we measure it in years rather than months. And if we look at the next slide, I wanted to share with you generally how it has been for US and UK. So what the progress has been made in US and UK in particular is that we are actually achieving the peak when it comes to the number of infected cases much earlier than what was forecast. But what is going to make a difference from here onwards would be the long tail risk that we are seeing, meaning that now we're seeing more variants of the virus circulating. And I think India is really a good example that you will have more potent variants coming into the mix. You're going to experience this longer tail, which sometimes can mean that certain economies, especially the developing markets, will be facing a much more challenging outcome. So the overall recovery is not going to be equal. You're not going to see all regions outperforming at the same time, but there will be instances where, like US and UK, because they are more ahead of the curve right now, they will likely be considered to be in the mid-cycle of the recovery compared to other countries which are slower and will therefore be considered at the early cycle of the recovery. Moving on now to where we see the different indicators suggesting the speed of recovery. So as we get into Q2, one of the key numbers that we're looking at would be in terms of manufacturing PMI. So the chart here is showing you the global purchasing manager index activity. This is an index that shows you how quickly the manufacturing sector has been outperforming the services sector. So the uptick there is to show you that manufacturing has in fact been leading the recovery. Whereas historically, what has happened is that services have always been the area that has led any kind of economic rebound. And the reason there is very straightforward. With the pandemic, services industry has been more impacted. To give you an example, we're not going to have tourism or F&B sectors rebounding as fast, and they continue to be impacted to some extent as long as we haven't reached herd immunity. So manufacturing has been the area that has been striving ahead. US in particular, with the stimulus as well as reopening accelerations, has been doing the best. In fact, you see the highest US activity level in the last 4 decades happening right now. So I think this is one key number to take note. We're also expecting that in the coming quarter, the rate of China's economic improvement may start to moderate because we're starting to see policymakers restraining credit growth. So overall, it is still a positive picture, but I think certainly we should expect differences across the regions. Let's now move on to inflation. Inflation has been a key topic, has come up quite a fair bit, and you see that in the news. And the talk has always been about whether inflation is creeping up. And are we going to expect interest rates to go up as a result of inflation going up as well? So what you see on the left-hand side here would be the inflationary expectations. And if you look at the blue line, it is actually coming off. So we do feel that inflation is going to be transient. It is a transitory phase that we're going through right now. And another chart that helps validate this particular view that we have is on the right-hand side. All of us knows that the Fed focuses on targeting inflation, and they are targeting a 2% inflation. Today, there is still a gap between where inflationary levels are compared to where the Fed is targeting. So this is reflected by the core inflation numbers. You do see a gap there. So because we are nowhere close to the inflation level that the Fed is targeting, therefore, there is a lot less pressure for the Fed to think about increasing interest rates. So overall interest rates should remain at a lower level for a much longer period of time. Now, as we start talking about business cycles, what is important is that we want to see at what juncture with inflation you're going to have stocks or bonds outperforming. So I think that's the top of my question. And you want to know, if we have a period of low inflation, are stocks and bonds both going to do well, or would one of them do better than the other? So that becomes an important consideration for you as you think about your portfolio allocation. So compared to the 1960s as well as 1970s, where there was a lot of high inflationary expectation and that materialized, at that juncture, you will see that both stocks and bonds have got a positive correlation, meaning that at that point in time, they will move in tandem. If stocks had a sell-off, bonds will also be suffering from negative return. However, today, we are in the right-hand side of what we are seeing as a lower inflationary environment. And that's where we should be expecting negative correlation between stock and bonds. And when there's negative correlation, it's always important to make sure that you have both in your portfolio, because that diversification can also act as a form of hedging. You want to hedge out the uncertainty that could happen. And because one of them could be outperforming and the other one may not be doing as well, your overall portfolio volatility would also be more or less mitigated. So this actually reinforces the view that the 60-40 portfolio, which I think many proponents out there are arguing that it's beginning to not be effective. I think this actually validates that the 60-40 portfolio is well and alive. In a low inflationary environment, we should still keep fixed income or bond allocation. Then there's another fact that I wanted to share with you, which is where we are in the market cycle. Because a lot of times, if you think that this is mid-cycle, therefore stocks may start to underperform, whereas in early cycle, we saw stock markets rallying a lot, right, which was last year. So what you see here on the left-hand side would be instances where, yes, in a recessionary environment, stocks would underperform. So that's your green bar. And you would see the investment grade bonds more or less provided positive returns throughout different kind of market cycles. But obviously, they did a lot of better when there was a recession and everyone was risk averse. So I think that is highly logical. But what I want to point you to is also on the right-hand side, which is that no matter at what juncture you're investing in the market, Could be early part of the recovery, could be mid-cycle, could be the late cycle of the recovery, or even in a recessionary environment, you will see that the median returns, which is the small green box within the blue bar, is almost equalized. So that tells you that, hey, it doesn't really matter, right? As long as I'm invested in the market and I have a diversified portfolio, which is how the return numbers were constructed here, I am still going to get returns that are even out as long as I remain invested. So this is again validating that the 60-40 portfolio does make a lot of sense. We should continue to have both equities as well as fixed income.
Okay, great, Wei Mei. I'm gonna skip these next slides, and we're gonna try to answer some questions. But maybe this one we just touch upon it. I mean, it's a slide that if you're a client of Endowus and have joined other webinars, it's been shown quite a lot. But I think that people panic, and it doesn't matter whether it's equities or fixed income. We've got a lot of questions about how fixed income markets have come down recently and what we should do. We also have a lot of questions on, whether I should continue to invest. We have a question in Slido asking, S&P 500 is at record high recently. Would it still be a good idea to enter the market now? So this whole concept of market timing is something that comes up again and again and again, especially if you feel that the markets are very toppish, or, we're in bubble territory and we're about to correct. We cannot predict that future outcome, and all evidence suggests to us that trying to time the market is just not something that we're able to do intelligently. And I think people oftentimes, even when you sell really well at the top and there is a market correction, you have to make two perfectly timed decisions to exit the market at the peak at the right time. But you have to enter the market back in, because long term the equity market always trends upwards. So if oftentimes in March as well, last year 2018, the same thing. I had friends say, oh, I came out of the market, I sold it, I'm such a genius. And then they didn't go back in, and as a result they held it in cash, and it's underperformed massively when the market actually rebounds the fastest. And so this is a number that shows over a very long period of time of 50 years what $1,000 invested would do in the US stock market, for example. It's 121x return, $121,000 in total. But if you just missed one day, the best performing day, and normally that day happens at the bottom of a crash and it rebounds very quickly. If you missed that one best performing day, the return would have fallen to 108. But if you missed 5 of those, just 1 week out of 50 years, it would have fallen dramatically to 77,000. And if you missed 25 days, which is just over a month, it would, dramatically fall, from 121,000 to just 26,000. Proving once again that, trying to time the market is really, really difficult. But if you do have cash and you are a conservative investor, then there are other options available. So we have a 100% fixed income portfolio, which is relatively conservative in any cycle. As I mentioned, even in March, during the COVID crash, initially fell, but actually, came back positive very quickly, and for the full year returned 5-6%, which was amazing. And then we have the ultra defensive portfolio, which is includes some short duration and income products, which is more defensive. And even in the recent correction, we see that it's done better and held your principal investments and capital preservation against the 100% fixed income. But if you're even more conservative, we have the Cash Smart Ultra, which is the new product that we have launched, which consists of money market fund exposure and also short duration, high quality short duration funds, which target about 2%, up to 2% in terms of yield, but obviously also has bouts of correction and recently has had a bit of a pullback. And the way to look at this Cash Smart portfolio range is that, to understand, first of all, that returns and yield correlates to risk. So if you are taking, higher risk, you will generate higher returns. But also, if you want to protect your capital, then you need to, adjust your expectations to a lower return. So Cash Smart Core is made up of institutional cash deposits and also money market type products, and can achieve up to 1%, which is phenomenal compared to anything you can achieve even at banks and deposits. And even the Singapore savings bond is much below 1%. So this is a very safe way to manage your short-term liquidity of even a few weeks to a few months. You generate a better yield than anything else out there and keep it safe. Cash Smart Enhanced takes a little bit more risk and generates slightly better returns. The actual realized returns is well over 2% for Cash Smart Enhanced, but the projected yield, we are being very conservative, is a range of 1.2 to 1.5%. And with that, you will have some exposure to short duration, you'll have some volatility, but largely, again, it will be very well protected. And if you can invest for and keep it in there for over a month, for example, rarely ever will you lose money in that one. But the Cash Smart Ultra is really for higher yield and also something that should be kept in there for a little bit longer. So up to maybe 3 months and beyond. It's, maybe your rainy day fund, emergency funds, or something that you may not need to touch for the next 3 to 6 to 12 months in terms of cash liquidity, then this is the place to put it. And, when we talk about cash and how it's such a big drag, in order to generate a 7.2% return, if you're fully invested, then that 7.2% returns can be realized. But if you just held 20% in cash, the investment portion has to generate 9.6%. Obviously, if you put that 20% in Cash Smart, it will help you a little bit. So your 80% can do a little less. But it's just an example of how cash is a big drag. And people talk about how they made 100% return in Tesla or crypto, but how much of your total assets is in that allocation? So you should always look at your portfolio holistically to address, the total wealth that you have, and how you allocate that is going to determine the long-term returns of your total wealth. So it's important to bucket your money into different periods of need. It's also important to have defined goals for the different cash flows and different aspirations you have. And then for each of these portfolios, you may actually asset allocate slightly differently. And on the Endowus platform, you can flexibly manage your assets across the various needs and goals you have, across the various time periods that you have. And we have all the flexibility of Cash Smart in the short-term liquidity management, cash management accounts, all the way to Fund Smart and advised portfolios for core and ESG. With that, I think we can wrap up the presentations, and going to answer and address some of the questions that you have. And I'll address the ESG question first, because there's multiple questions about ESG portfolios. How do you allocate between core and ESG? We've had some webinars and presentations for our Endowus ESG portfolios. We also had one with the fund managers for the equities portfolio, and then another separate one with the fixed income portfolio managers as well. And they're all like global brands like PIMCO and Schroders and JP Morgan Asset Management, but also they're experts in the ESG field who have been investing in this space for decades, and utilize the best practices that exist in the industry. So I would advise you to please check out those YouTubes in the series underneath, or you type in Endowus and you can look for it. But in the meantime, the ESG portfolios are an active portfolio, although we have a strategic passive asset allocation. It's a risk-based portfolio, so you can manage it between equities and fixed income to the risk that's suitable for you, to your profile. It's a multi-manager, multi-asset portfolio, so it has flexibility in it. But it is something that is very values-driven. And so it is your personal preference and your risk profile that would determine how much you put into that ESG portfolio. I think a good starting point for people who are interested in investing in ESG because of the values you hold, if you believe that ESG is a long-term, contributor to returns, then I think that ESG could maybe represent about 30% of your portfolio, maybe 25%, a quarter to a third of your portfolio. And I think it will still provide you with a broad global diversification and exposure to multi-assets. It's developed as a best-in-class product at really low cost, exceptionally low cost. And I think that many things that have held people back in terms of, people's concerns about sacrificing returns to do good, I think that has been now, I think, proven to not be the case because of the recent outperformance. And while we're not saying that it will continue to outperform in the massive way it has in the recent years, we still believe that over the long term, these companies who are, better stewards of their capital, better stewards of their resources, better stewards of the environment and also their employees, and have high levels of governance standards, it's plausible that these companies will be the winners over the long term. They'll be the ones that will be manufacturing great products for consumers and businesses. They're the ones who will be providing the right type of service with happy employees in providing the services that people need. And consumers will choose those brands and companies that are much more responsible, hold them accountable. And as a result, these companies, both in the equities and fixed income space, will be able to deliver long-term returns adjusted for the risk. So every academic research has shown that ESG and high quality ESG companies provide a better risk-adjusted return with lower volatility. So despite the fact that they're active portfolios, which by definition have higher volatility and tracking error, I think that the ESG portfolios have this very unique characteristics of better risk-adjusted returns. So we hope that's the case, and we believe that we've built an exceptional quality advice portfolio for ESG. And it is the first and only available for retail investors for this type of institutional quality and institutional share class access. So that's ESG. We have the SRS portfolio coming very soon. So we will be launching that in the next few weeks. We'll be in touch. Please sign up or contact us. We'll definitely be uploading that and launching that very soon. Somebody asked about ESG portfolio performance. We've only, really launched the portfolio for just over a month now. So it's really too early to tell. It had a little bit of a slight underperformance versus the core, but it's also come back very strongly. So from what I can see, and I've invested in the ESG portfolio as well, since I invested, the portfolio is up 3.22%. And I believe that it has outperformed the core portfolio very slightly. But it depends on the date that you invested and how long you held it. But really, I think it's too short a time period for us to be assessing its long-term performance. So please take a look at it and educate yourself on it, and also invest the right amount and stay disciplined. That this is a long-term portfolio that eventually should track or do better than any ESG portfolios and indexes that are out there. Okay, I don't know if Wei Mei, you have the Slido open, but if you see any questions that you want to take, please feel free to jump in and ask, or jump in and answer any of these.
Sam, I think I will ask you to respond to two questions rather. So I think there were a number of queries regarding new solutions that we're developing, particular income-based solutions with distributions, as well as retirement type of portfolios. So what's your take on it?
Yeah, so it's actually a project that Wei Mei, myself, and the team is working very hard on. So income portfolios are coming, guys. So please bear with us. We've always said that it's something that is needed, and we'll launch it, but it's not a priority because on our platform you can actually invest in broad diversified portfolios, and we have no transaction cost. It's a seamless platform where you can put in money and take out the very next day, and there's no cost involved or friction. And so, what you should do is actually maximize the returns long term of your portfolios, and in the accumulation share class that we choose for you, which is the more efficient way to build wealth over the long term. And then if you need something, if you need to take money out, you should just take it out in the exact amount that you want, when you want it, directly from your portfolio. I think that many people have been trained because, there's penalties when you withdraw from unit trust too early, or, there's a transaction cost or a penalty that is involved in terms of the cost of taking these out. But Endowus is built it flexibly and seamlessly so that you can just press a few buttons and get your money out into your bank account. So, it is already a quite easy to use and seamless product, but we're developing really unique income solutions that will be suitable for retirement targeting, older age, people who want, some supplementary income, and also younger generation that maybe want some pocket money and also grow their wealth. So we're designing portfolio solutions that will be most suitable for our client base, and we're getting feedback from clients as well. So please write in and ask us and tell us what you need. We're happy to always listen to your input and feedback about new solutions. As you know, we've been working so hard to launch multiple products. We are actually, the fastest growing digital platform, but we're also the platform that launches the most number of products and solutions to meet the needs of our various clients. And so, we're very happy to meet your needs for the income products, and we'd love to hear your feedback as well. So that's coming.
Sam, there was also a question on ETFs being utilized in portfolios.
Well. That's right, ETFs as well, and in that dimensional products as well. Multiple mentions of new solutions, and so those are coming as well. ETFs is, we always say is, a wonderful instrument. We just wish there were SGX listed, local listed, Sing dollar denominated ETFs here available for us to trade intraday, but unfortunately it's not available. And many of the other robos and digital platforms utilize, US listed ETFs because there's no other choice. But it's highly inefficient in terms of FX because, some of these platforms charge you an exorbitant FX cost. Also, there's natural exposure to taxes. So US withholding tax, which is quite high, 30%. But also, God forbid, anything happens to you, there's an estate tax, inheritance tax, because it's a US asset that you may be liable to as well. So those risks are there. And, some of these portfolios and ETFs are not, very passive. A lot of people these days, especially robos, use active ETFs. And I think that's not very healthy. So we have to use the ETFs that are passive, it's low cost, and, removes the FX cost. So we're working hard to find solutions that would be efficient. And so we'll launch that when we are able to. So please keep a lookout on that one as well.
So I think one important question that came up based on what we discussed today about value and growth is whether our portfolios have got a much stronger value tiered with dimensional, and therefore we should explore adding any funds that's going to be emphasizing growth. So what's your take on it?
Yeah, so when we launched the portfolios for the core advice portfolios, we actually started with the only dimensional funds and equities. Since then, we've added some, other passive instruments like the S&P 500, global equities portfolios in CPF, and also our cash portfolios. So we've diversified the portfolios a little bit, but dimensional, I think, obviously does have these tilts. So it's really important to understand that, factor-based investing has multiple layers and differentiated gradients of, how exposed you are to those factors. Now, dimensional's approach is to have a broad market exposure. So own the whole market. So their portfolios will be the most broadly diversified, even more broad than the MSCI All Country Index, which would have typically about 900 stocks in there. But Dimensional's global portfolios would have, 12,000 companies. So it's even more broadly diversified than some of these indexes that people talk about. And then they tilt the portfolio towards those proven factors of return, which are value, small, and quality. And they are not normally an equal weighting. So there's no natural tilt towards value or small more than the other factors. But they combine that and do that really efficiently at low cost. So the overall portfolio cost is really low. Also, it's broadly passive. It's probably the most passive exposure to global markets that we can find, especially here in Singapore and Singapore dollar denominated, and at that low cost. So it's important to understand how Dimensional implements their strategy, but you are still exposed to those values, small and quality tilts, and that's something that resulted in the portfolio underperforming slightly last year, but outperforming this year. So there is this slight difference, but overall, if you look at the performance, it's actually very similar in terms of the returns of the index. But as you have highlighted, I think there is opportunity for us as we launch new solutions to launch 100% passive solutions or 100% smart beta solutions. So we would love to receive more feedback from our clients to prioritize the products and solutions that are much needed from our investors.
Sam, I would want to address a question on CashSmart because some of the more recent investors who participated experienced a negative return over the last couple of weeks that they had put their money to work. And I think the question is whether, given that rates may rise, will they experience more mark-to-market volatility? I think on that front, my view here is that we're expecting short-end rates to remain at a low level. Is going to be anchored because, like we mentioned earlier, the Fed is monitoring what would be the inflationary rate going forward, and it's nowhere near to the 2% that they have been targeting. So I think if you look at consensus view across the markets, you will see that most houses would be expecting interest rates to remain low until 2023 or even 2024. So with that in mind, I would anticipate that for your CashSmart portfolio, where it is short duration, you're invested in instruments that will have much lower sensitivity to interest rates, you should be relatively well protected. So of course, there could be some periods of negative returns, but I think we have also emphasized that the time for it to recover can be fairly short. Let's just say with the CashSmart Core portfolios, with the drawdowns that we've seen historically, it takes 6 days to recover. With the enhanced portfolio, it takes 57 days, and with Ultra, it takes 100 days. So more or less in terms of time frame, if you give it up to a maximum of 100 days, I think history has also shown that it can recover, but it is always most difficult to think about exiting when you're seeing some mark-to-market losses. So I think you should take the view that if you're going for a higher yielding portfolio like CashSmart Ultra, you should think about an investment horizon of, let's say, at least 3 months. So that would be how we looked at it. Not so much that we're expecting negative returns. If that was the case, we wouldn't have gone out to you to highlight that it's right now between 1.8 to 2% in terms of the projected yield.
Yeah, and I think that CashSmart Ultra, since it launched on 15th of April, has actually given us a positive return so far. Because we saw a rebound in fixed income, and then it's pulled back in the past few days. But I think that long term it should generate the type of yields that you expect. And so I would that 100-day recovery and the worst case outcomes, those things are things that happened during the COVID crisis in March, which is once in a generation or once in a decade kind of event. The last time that happened was obviously 2008. Literally it was 12 years in between the 2008 and also 2020 March. So it's not something that happens very regularly. Even in the most recent fixed income correction, enhanced fell by 0.2%, I think. and Ultra may have fallen slightly more if it was available. But since then, it's actually generated positive returns since the launch. So I think that we should be mindful of the risks, definitely, of investing in short duration fixed income and the higher yielding portions of cash smart. But if you have that time horizon in place, then I think it should be reasonable to estimate that the projected yields, or even above that projected yield, is achievable with the products that we have built. With that, unfortunately, we've gone way over our time again. So I'm just left to maybe give a quick plug for the next Endowus Live event in 2 weeks' time. So there's no webinar next week, but the week after, we'll be combating investing FOMO and market anxiety with two of our brightest stars, up and coming Shengxi and Maddie. And I just want to thank Wei Mei today for joining us and presenting a wonderful presentation on the markets and the review.
Thank you, Sam, and thanks everyone for dialing in this evening. Happy Labor Day, and looking forward to seeing you in 2 weeks' time.
Okay, wonderful. Thank you, everybody. Have a wonderful evening. Bye.